Hi friends, this is Ankur welcoming all viewers to the session on liquidity ratios, which are one of the very widely used ratios. Why is this so critical, out of the five categories, is the fact that as a evaluator, as an analyst or as a reviewer, I am always interested to divide the performance of the firm in two parts, the short term and long term. And the short term is, let's say, like the 12 months. Liquidity ratios are basically related to these short term. So it is extremely important that if anyone wants to evaluate the firm and any kind of an ability for the next 12 months, this is something that they can't ignore. Okay, so the liquidity ratios are basically, as the name suggests, how much cash or cash equivalents. Now I'm not getting into the real formula, but I'm just explaining the meaning overall. How much cash stroke cash equivalent stroke other resources does the firm have to pay off the liabilities and obligations which will arise within 12 months. Now, in the overview video that you have seen, I've categorically asked you to write that time is critical. The nature of liability is not critical. What I mean by that, these ratios basically try to assess the bankruptcy probability of a particular firm. What is a bankruptcy? Bankruptcy does not mean that the company is lack of profit. Being a sick company, inefficient company is different, and bankrupt company is different. Bankrupt is a simple, bankruptcy is a phenomena where the regulators, or let's say the courts, take over your company for some time, run it on your behalf, pay off the liability because you are not able to pay them, and then hand over the company back to the old owners so that the company can function as it is. Okay, so it's a very normal. I mean, it's not a normal thing, but it's not like a once in a lifetime kind of an opportunity. You might go bankrupt a couple of times. It's not closing down at all. General Motors, who filed for bankruptcy in 2008, is still running fine. Okay. Now, what is bankruptcy? You're unable to pay your liabilities. Doesn't matter how much profit do you have. So the payment has to happen as per some of the resources. I'm going to list them down. 1, 2, 3, 4, 5. And obviously the resources that you're going to use to make payments, that is something which is called as your current assets. I'm going to write it in a way, cash and bank. I want you to make the same listing here. Then you have marketable securities, short-term investments that you would have made. Then you have your account receivable stroke debtors stroke trade receivable. Then you have your inventory. And then you have your prepaid asset, prepaid expenses. So these are the broad 5 current assets that any firm would have. Now, there is a particular order in which I am writing it. The order in which I am writing it is the liquidity. As you move down, the liquidity goes down, and vice versa. Now, what are these 3 ratios that are mentioned here? First is the current ratio, second is the quick ratio, and obviously we'll talk about this defensive interval in a while. What is the difference between the current ratio and the quick ratio? Here, the time to pay off liability is 1 full year. However, in case of a quick ratio, the time to pay off liability is, let's say, 1 to 3 months. That's all. You don't have full year to pay off the liability. Now, I'm not saying that actually, the company doesn't have, 1 full year to pay. All I'm basically saying is that within that 1 year assessment, remember I said that this ratio is assessing in what, so within those 12 months I want to bifurcate it further between the capacity to redeem the liabilities in 3 months and capacity to redeem the liabilities beyond. So I'm just going a little more refined in this approach. Liquidity is overall less than a year, but within that year you have within a quarter and then let's say overall 1 year. Okay, so more short term is quick ratio, a little long term of the spectrum is the current ratio. What you see here that the denominator are same. Okay, so the total liabilities that needs to be paid will always be taken in denominator, that will not change. But what is changing is the numerator. If you look at the numerator of the current ratio, all five, I want you to write here all five assets are being utilized. Obviously, the current ratio will be a bigger number. However, in case of a quick ratio, you exclude inventory and prepaid and just take top 3. The reason for that, taking top 3, is that since you have only 3 months to pay, you may not be able to produce your raw material into finished goods and then being able to sell, and being able to collect. So, and obviously, prepaid expenses is also quite possible that you would have paid for the next year. So these are 4 and 5 are the values that you have created for yourself, which you can redeem only beyond 3 months. I mean, 3 months are too less for their realization as such. Okay, so therefore we tend to exclude them in the quick ratio. I mean, as name suggests, it's a little quick. This is a very, very important ratio. Very, very important ratio. It's called as the defensive interval. Now this is the ratio I want you to write here. Going concern is defeated. There is an assumption that we have taken before the start of the accounts wherein that the business is going to continue forever. That's the basis on which the accounting will be done. However, if sometimes because of any condition, be it a political condition, be it an economic, be it a business scenario, anything, the business is about to be closed down, then the management would like to know what is the time frame up to which the head can remain above the water level. I mean, you can still sustain the operations of a company. I'll give you a very simple example. If let's say my individual's daily expense is $25 a day and I have a saving of $200, for how many days can I sustain? I can sustain for 8 days. So up to 8 days I am defended. After that I am going to be exposed. So what are these resources that the company can take in the numerator? This is exactly the same resource that you have in your quick ratio, top 3. Okay? Because inventory and prepaid again will not be able to be utilized because defensive interval is not calculated in months and the years. It is calculated in days. It's like very, very short term thing. It's a situation of an urgency. Okay? So that's like the meaning of your defensive interval. What you have to understand here is that defensive interval is calculated when the CFO and CFF, the normal business operations and any possibility of taking loan is not there. See, a company will never have to, utilize its own saving if they're able to make good sales or they're able to borrow well. If both of these things are not there, then there is an issue. And the company would like to calculate the defensive interval. Okay? Now, before moving to the next point, just wanted to kind of, raise one of the aspects here. Let me just clean the board a bit. There is something also called as a cash ratio, which is the third ratio here, cash ratio, wherein the current liabilities here are in the denominator and it's only the cash and marketable securities. Basically top 2. This is the time frame is only 1 week. So cash ratio will check the capability of the firm to pay off the current liability within 1 week. Obviously, current ratio is going to be more compared to the quick ratio, which is further going to be more compared to the cash ratio. As you move down, the time frame of repayment goes down, the lesser is the coverage. What happens to the unit? Current assets is also in dollars, and this is also in dollars, so dollar cancels out, and then you have the ratios coming up in times. Okay, so look forward to speak to you in the next session. Hope this was useful. Practice a lot of examples, very, very interesting and important from an exam standpoint. Be strong on the fundamentals. Receivables is part of the quick ratio, but receivable is not part of the cash ratio. Inventory and prepaid expenses are part of the current ratio, they are not part of the quick ratio. Okay, small aspects are going to make a lot of difference. Another important point here, that the average daily expense that you take here has to be average daily cash expense, because if something doesn't have to be paid in cash, then that is not a problem of worry for me. Okay.